Ladies and gentlemen, it has come that time once again in which we will have our trader strategy meeting. For those who are new to briefing, this is where we bring all our trading team together and we discuss the themes that we're going to be seeing for the course of the month and maybe even a little longer term. I'm going to welcome in all of our gentlemen here today. I'm going to start with Brett Manning. You know him as Chart Trader. And what we typically do is take a 30-foot thousand view and we will go over the macro and kind of work our way down. So with that said, Brett, how are you this morning?
I'm doing pretty good, Jim. How are you?
I'm doing all right. So, love to get your take on where we stand in the markets. If nothing else, Brett, you can say that we have a little bit of political uncertainty off the table.
A lot of political uncertainty off the table, I would say, more every minute. But yeah, this has gotten to be an extremely wild tape at this point. And it reminds me a lot of what we saw in early January 2017 and a little bit, I would say, of a kind of 1999 type market. And the data that I've seen on sort of structural changes in options activity suggests there's just an increasing amount of participation by people who may be too young to have clear memories of 1999, and I think that's a contributing factor that allows it to really kind of mature in that direction. But yeah, so turning to the big shift this week, I think when the dust settles, the Georgia Senate result was, my sense, and people I talked to suggest it was completely unexpected, so it wasn't priced in at all. Even though there was a slight lead in the polls by the Republicans coming in, or by the Democrats coming into the beginning of the voting on Tuesday on election day. Betting markets were still pricing in Republican control of the Senate, and a lot of people that I talked to just basically were seeing the same dynamic as maybe the polls are skewed slightly, but there's no way Georgia's going to end up flipping. And they flipped, and we've seen the consequences of that already overnight and this morning. We've got suggestions of stuff on the way in terms of taxes, in terms of infrastructure, in terms of stimulus, and it's all kind of getting paired together. And I think the market's taking it as a positive. It took it right off the bat as a positive. We saw that in interest rates. We saw that in just the feel of the tape. Since before the Capitol siege, the tape was really clear on Wednesday morning in terms of money just pouring into the market. And I think the most interesting thing to note there is the positive aspect of that is, I think, not just about policy ideas. And I posted something Wednesday morning to this effect. I think that a lot of people had gotten into the mindset that a divided Congress was a positive for the market because it removed the possibility of large increases in taxes from a new left-leaning administration and dominant paradigm in Washington, D.C. And my sense now is that was just an incorrect idea. And I think the lens to see this through is we're in a crisis, and whether whoever is in charge, if there's a kind of partisan polarization that is tying the hands of everybody in Washington, D.C., a gridlock, in a crisis, that's bad. It's bad even if you disagree with the politics of whoever's in charge. There are simple and obvious moves that have to be made. And I think the market's confidence that we've moved into a situation where the polarization is taken off the table somewhat, and there's going to be some kind of consistent same page situation for dealing with basic steps in a crisis. I think that have been limiting the market's ability to price in upside, certainly have been limiting the market's ability to price in growth. We're seeing that now in what the bond market is doing. We're just taking that constraining factor off the table and allowing common sense moves to just address crisis issues. And I think that's probably the most important thing that's shifted. And I don't know if that's been talked about a lot, but that's definitely my sense. And I think that's also actually, and we got a question in our feedback a few minutes ago, I think that's also the same thing when you start to look at the dollar. You look at what we've seen. So we had a negative jobs report this morning. We've got the idea that all the stimulus is coming on the table. But remember, the dollar's been getting hammered for the last almost year. And I think a big part of that is just a sense of a partisan death spiral, political dysfunction during a crisis. And just getting everybody back on the same page, taking that factor off the table, I think really shifts a lot. I think it's shifting what we're seeing in the equities market. I think it's shifting what we're seeing in the bond market, and I think it's shifting what we're seeing in the dollar.
All right, Brett, there was one thing that I wanted to touch on that you mentioned, and you said talking in relation to the stock market and moves that make sense, and you had mentioned growth. It's hard for me to justify some of the moves that we're seeing in a lot of these growth names at valuations at the places that we are right now. So I'd love to get your take on that type of theme.
Yeah, so I mean, again, I think that we shifted from a very long-standing institutionally driven stock market, um, pretty much from 2008 until, let's say, the beginning of the COVID-19 crisis. And in the midst of that process and over the course of last year, there's a lot of data to suggest we have shifted to a retail-driven stock market. And I think you can see it in tons of exits and IPOs. The IPO rate is massive right now. Share expansion across the board, lots of issuance. Even with interest rates this low, which is interesting. We've started to see stock splits again. All these sorts of things point back. And again, what I talked about with the options market, where the put-call ratio has shifted, I think, structurally, which shows a lot of small accounts who they aren't even bothering with shares. It's just really basically participating through calls. I think all of that suggests that we have a retail-driven market. So, it's a Wild West, and eventually there's going to be tears, but it's right now, the process is going to play itself out. We're in an epic kind of mania.
All right, well, let's parlay that into an interest rate discussion here, Brett, where, well, we can even bring Gavin into the conversation because we have financials on deck starting next week. We've had a good start to some of the commentary anyway. In late December, we had the Goldman Sachs Financials Conference, and they had some really good things to say. But as we're looking at the 10-year rising, let's see, current quote right now, we're at, we're well over 1%, 1.11 right now. As far as the 10-year, we should see this expand, and that's good for the lenders. So let's talk about interest rates and where we see the banking stocks financials going from here.
Is that for Gavin or me?
Well, my apologies, Brett. I wanted to talk about where you see rates headed. I mean, is this just the tip of the iceberg as far as rates? And if so, then we can talk about the earnings.
Gotcha. So, yeah, I mean, I think that so there's this model. It's called the risk parity model. It's been in play for really, it's been a dominant part of that institutionally driven market environment that we see kind of going by the wayside as of last year, where you're really just alternating exposure based on volatility and based on cash levels held. And I think participation in that kind of model has been dwindling for the last 2 years. It started to break in 2018, 2019, started to break a lot more last year. And so now we've got this new emerging idea, which is something that used to be a mainstay idea. And that is the great rotation notion. When you have low interest rates, you've got a lot of money that's locked up in the bond market. It might as well be cash on the sidelines. Well, what if growth rates start to change, inflation rates start to change, and you start to see money just migrate from the bond market into the stock market? It almost seems like an old idea at this point, but it used to be basically the standard assumption in terms of cyclical changes. However, with multiples already where they are, to a lot of people who are participating on an institutional basis, that's going to be a little bit scary. But interest rates, I mean, sentiment on the bond market is already just trash. There's almost nobody out there that I talk to who thinks that the bond market isn't going to keep falling, but that doesn't mean that it won't keep happening because there's so much money that's been locked up there. So interest rates can move higher. Obviously, this is tied up in what Gavin and I have spent a lot of time talking about, which is the shift in inflation assumptions headed into the next year. Possibly we have a shift in terms of monetary policy paradigm towards something that approximates an MMT style understanding of monetary policy, where rates can be, how much expansion can come into place. But as I said, so as rates start to move higher, there are plenty of periods in history where the stock market can move inverse to the bond market. In other words, stocks can move in the same direction as interest rates. So far, we're seeing that since the Georgia Senate results. We're seeing a breakout to the upside. And I think at a certain point, you're going to really start to see a test of how much speculative activity can keep driving the stock market, because you're going to see institutional money start to get concerned unless the Fed steps back in, and I'm sure this is something Gavin will talk about, and starts to do some kind of curve control.
Yeah, Brett, and that's one of the things that we've certainly seen commentary on in the last minutes. Powell failed to address it in the December 16 meeting, but they were talking about buying the long end of the curve in order to control these rates. But I guess for me, Brett, one of the key stories, and we talked about this in our sentiment and flow show a couple of weeks ago, and that was the jumping on of increased rates as one of the top concerns. It came in second, I believe, behind COVID, right? And had not been on in the prior month's survey. So it is interesting to see, because I think the general thought process, Brett, and tell me if you disagree, is that stocks will remain attractive based on lower nominal yields. And the idea that any moves that we're seeing right now, that the Fed will be able to control it and tamper them down. Do you see any risk to a possible runaway yield here that could disrupt kind of the primary 2021 thesis?
I think the risk is liquidity. So I think that if it's an orderly move, I just don't think that it's going to become a major. Now, so first frame it as we have a sentiment environment in the equities market, and we'll talk a little bit more about this, where we've already got a lot of risk. It doesn't matter what. If something comes along that's problematic, there's so much leverage and momentum and complacency piled into the equities market. Whatever it is, it doesn't really necessarily matter what it is. It could be a problem. But as long as there's not something else, I think an orderly move higher in yields is probably not going to be a huge issue until we start to get up maybe above like 2%. But if we start to see the rate of change, I think, is the big issue. If the rate of change starts to become scary in the rate markets, then it's going to instantly be a problem. And that's really, it's second derivative. And I think that a lot of that comes from the fact that so much has been quarantined on the Fed's balance sheet that there's not that much liquidity, and the possibility of some kind of huge spike out of the blue that becomes uncontrolled, and if it isn't immediately addressed and immediately contained, that becomes an enormous risk factor.
Right. And I think the key takeaway from the debate around rates, and obviously the dollar factors in here too, Brett, is right now the market definitely, while they don't have a lot of confidence, I would say, in the Fed boosting the economy, I do think that there's still plenty of confidence in the Fed being able to keep these rates capped. And as long as that stays in play, then I don't think that your typical fear around inflation will be on the rise. Would you agree with that statement?
Yeah, absolutely. Yeah.
So, and I just think that that's really kind of the key crux of the argument here for markets moving forward. The weaker dollar having people pushing more into the emerging markets. One of the things that I'm looking around for is an emerging market ETF, Asia ex Japan, because Japan's probably the one that's hurt the most by a weaker dollar, where all the other Asian currencies should be able to see a little bit of a benefit in their economies, see some growth from that. So, all this is going to factor into where money's flowing into 2021. So I think the argument for where you need to invest in is going to stop and start with the dollar and rates here going in. So I see that as the top story for 2021. Would you agree with that, Brett?
Absolutely, 100%.
Okay. And then I guess we could segue into the financials from here, where I'm just going to do a little bit of a quick preview since they are on tap. Next Friday, a week from today, we're going to really start seeing earnings season getting underway with the Q4 numbers for JP Morgan, Citigroup, Bank of America, and PNC. And obviously, banks have been seeing a pretty nice move here based around this move in interest rates. But a couple of things I just want to point out for the financials going into this earnings season. And we saw it playing out with Jefferies earlier in the week. They posted some really good numbers here for their investment banking unit. Net revenues for the unit were up 133% year over year to a quarterly record of 916 million. We saw fixed income or their equity trading revenue up 63% year over year, with fixed income being a primary driver there at 61%. Now, this is all setting the table for pretty high expectations in the banks with primarily investment banking units such as a Goldman Sachs or Morgan Stanley. Of course, Bank of America, JP Morgan, and Citigroup all have pretty large trading segments. A Wells Fargo or the community banks or regional banks, they're more steeped in your traditional banking. So the first looks we're going to get is a lot of the money centers with the IB units, and that's going to be some high expectations. And the recent raise in rates is also going to help ease some of the concerns around lower net interest income or lower net interest margins. So the things that we're going to want to look for here, just to get an idea of the economy, is how's loan demand looking out there for people? Are banks seeing a little bit of a pickup? And this is going to be one of the key stories, because one of the things that Brett and I also talked about in the Sentiment Flow show that's going to be key for the markets is a return to CapEx spend. We saw from the fund manager survey that was gaining on what fund managers want companies to see around use of capital rather than paying down debt, which had been by far the biggest one since the COVID crisis had kicked off. So if we're looking for a little bit of an escape velocity in the economy, we're going to need to see banks talking about people looking to expand on loans and a pickup in loan demand over the last couple of weeks, especially if that loan demand's coming while rates are on the rise and while COVID cases are on the rise. So for the economy, that's going to be the primary thing we want to look at for banks. And then, of course, we're looking at the credit risks, which from all things and all signals that we've seen is not on the table and should remain a little bit of a distant afterthought here, particularly if we see Congress pressing forward with a stimulus package that should help ease some of the burdens around mortgage debt and credit cards. So that's going to be the second thing that we're going to want to look at there. Net interest income and net interest margins naturally will be key. We should expect a quarter over quarter pressure on these, but the recent rise in rates, what's going to be more important is an outlook to 2021. And then, of course, the IB units here. People might try to talk about the quarter-over-quarter sequential decline in fixed income and equity performance. That's just really going to be coming against some pretty tough comps. So I'm going to be more interested in the year-over-year numbers and really the look forward that these banks are going to have. And this is really going to help, as per usual, set the rest of the tone for the earnings season and really give us a little bit of a look into the lifeline and the financial conditions of markets as a whole, which expectations are pretty high. So again, what we're going to be looking at, and I'm going to break into this with Craig here on the overall markets, is for these financials to post good numbers and then see a sustainability in their interest in terms of their stock performance and price action. Any sort of wavering around the price action and a sell the news, I think is going to be pretty notable, and I think that's going to be one of the key things for the Q4 earnings season. So I just talked about the banks, and now we're going to break into the overall Q4 earnings season look, and we're going to bring Craig in here. For those of you who don't know, Craig's background is really steeped. He managed our earnings season product for nearly a decade, and no one's more in touch with earnings than Craig. So I'm going to let Craig step in here, talk a little bit about what some of the expectations are around this Q4 earnings season, and I'll jump in here and there with a couple of figures that I'm seeing out there, and hopefully that can give you guys a good primer for the next few weeks. So Craig, what do you think about this Q4 earnings season?
Thanks, Kevin. Well, I suppose it's going to be more of the same in terms of strong numbers. Stepping back a little bit, as of right now, it looks like 2020 earnings on the S&P 500 are set to fall something like 17% from the record in 2019. And, considering the pandemic, that's pretty incredible, right? The corporate America has proven to be quite resilient. Obviously, there's certain sectors, travel, leisure, hospitality, restaurants, a lot of the most impacted stuff, unfortunately, is the smaller businesses, which are struggling. But obviously, that doesn't really have much of an impact on the S&P 500. Earnings are expected to hit a new record this year in 2021, growing about something like 22%. As it's pretty much a quarterly dynamic that we see, companies are able to manage their expectations. I think earnings are actually expected to fall at a larger rate than they did in Q3 year over year, but earnings usually come in well above what the consensus is. I think it's about a low double digit or mid-teens decline.
It's usually about 3% higher, right, Craig?
They come in somewhere in that neighborhood above. So what was it? I think 11. They're supposed to fall 11% in Q4, which is worse than 7% decline in Q3. So we can assume it's going to come in around the same. If not, I wouldn't be surprised if it comes in slightly better, down 6, 7, 5%, whatever it is. What's the big theme going forward, I suppose, is that starting in March, all the comps are going to go from very difficult to very easy. So, unless you're at a Zoom or a DoorDash, where all of a sudden the comps are going to become really difficult, most companies starting in March, so at the end of Q1, and then for the rest of the year, suddenly are going to be posting just some really fat, impressive growth rates, which is, part of the reason why I suppose that the market has been so resilient. We had such a sharp downturn for a couple months there, and again, the market most companies showed resiliency, and now we just have it's forward looking. We're discounting what's going to happen, so the growth rates are going to look really impressive. So if we are able to hit a new record in terms of earnings in 2021, which I would assume would be the case, the outlook is quite strong going forward, which is, sort of justifying the rallying we've seen for the last 9 months. But, it comes back to the valuation. So the market is now trading, the S&P 500 is now trading at nearly 23 times earnings for this year. It's like 22.5, 22.7, depending on the exact numbers. But that's really expensive. I mean, for a while, the market was trading like 15, 17 times. We struggled to get above 17 times for a while over the last decade, and now we kind of had that excuse over the last year because earnings were depressed. But now, with earnings hitting a new high, the market seems to be pricing in that we're now kind of early in the cycle. We had that 2-month depression, and now it kind of sets up another expansion cycle. So yeah, 23 times earnings is rich, but if we can grow next year as well, then the market doesn't look too bad. And obviously we have some fiscal support that should be coming. We still have all the monetary support. So the outlook for corporate America remains strong. The question of whether or not there's going to be a lot of companies still punting on guidance. A lot of companies stopped giving guidance because they realized they didn't have to. So it'll be interesting to see which sectors embrace it again. But, we're going to see a ton of pre-announcements starting. We already have this week, but starting Monday morning, especially because of that JP Morgan healthcare conference. And really for the next couple weeks, we're just going to see a deluge of pre-announcements. Most of them, I would think, are going to be pretty positive. I'm sure there's going to be companies that have been impacted by the more recent lockdowns. There was a lot of pent-up demand in Q2, Q3. Maybe it softened a little bit, but generally speaking, I think there's going to be a lot of good news, which is usually the case coming out of corporate America, because they are seasoned in managing their expectations. But again, starting in March, the numbers are going to start looking really good for the rest of the year. So that kind of is a bullish underpinning that we have in terms of the fundamentals.
Yeah, and Craig, for revenue expectations, they're generally flat to slightly up on a year-over-year basis, right?
I think so.
I was seeing plus 0.3% overall for the S&P 500. So,
and that's next year on top of 2020, or I'm sorry, this year on top of
the Q4 2020 numbers.
Oh, okay. I don't have that in front of me, but yeah,
I saw that in two different places. So, just kind of keeping an eye out on the top line growth too. In terms of sectors, obviously transportation and energy are going to remain under pressure in terms of the year-over-year declines and expectations. So, surprises higher in energy will be something key to watch in case we're able to get a boost higher in that space, which has certainly been one of the hotter spaces over the last couple of weeks here. Technology, I was seeing their earnings are expected to be down slightly, about 0.7%, but revenues, it's going to be one of the key generators for the top line, expected to be about 9% higher in the S&P there. And then a few of the other areas that we're looking at in terms of strength, construction is expected to see some strong earnings. Autos, with a lot of those EV plays, helping provide a boost. Medical, basic materials, and aerospace are all expected to see a year-over-year increase. One of the things that I just wanted to mention in terms of key themes that I'm looking at for this Q4 earnings season is going to be around some of the commentary from these companies, and that is, are they seeing inflation on their production costs? We saw a little bit of that from Micron, and are they able to pass along and show any pricing power to improve their profit margins? The transportation sector is going to be a key example of this, where I've been pretty bullish on a lot of these truckers, and I'm looking to see if they have indeed still kept that pricing power and able to offset some of the higher costs from materials and from just COVID protection of employees. So I think that's going to be another key theme that we're going to want to watch for the Q4 earnings season. The other one, as I was talking about, was that CapEx spend. Are we going to see an increase in that moving forward in order to replenish inventories, which builds upon the theme of we saw some supply shortages in the Q3 earnings report around some of these semiconductors. So are we going to see people looking to replenish these inventories, which should suggest stronger demand moving forward to 2021, which hopefully, Craig, I think you would agree with me on this, is going to lead to more guidance around 2021 and suggest that there's a little bit more clarity around a vaccine. I don't know if we're going to get that early, but I think that's going to be one of the key items that people are going to be looking at in terms of, are they going to want to buy from these levels? So, I think these are a few of the themes that are really going to be pertinent. And the final one I would just point out is we've got a little bit of that globalization rewired with that dual U.S. versus China demand. How's that impacting the overall global supply chain? And I think looking for companies that are going to be winners and losers in this is going to be a key early theme for Q1. So that's exactly what I'm going to be looking for in the Q4 earnings.
All right, I do have a quick question, and either Gavin or Craig could answer it, I think. as far as what you experience in terms of maybe reconciling more earnings growth than top line growth, how do you come about that? Like, what's your take as to how that happens and how that can happen this particular year?
I'm sorry, you're saying differentiating between top line growth and earnings growth?
Yeah, so if we're going to see, I forget the number you said, but we're going to see X amount of earnings growth, but top line growth is going to be flat. How do you reconcile that? What's going to cause the earnings to grow?
Well, yeah, so I mean that is a good point. It's, the top line trends are what are really a better indicator of how the economy is doing, and true demand and how things are actually performing in the real world. What makes the S&P 500 in corporate America so strong and resilient is that they have the ability to cut costs and, especially the timing of this, most people were kind of waiting for the economy to stall out, right, over the last year or two, because we were 10 years into the cycle. So after the financial crisis, companies trimmed the fat, right-sized their businesses, and it allowed them to bounce back stronger in 2009, 2010, et cetera. And so they were kind of due for that anyway. So now think about all these companies that laid off in a big way in last spring, and companies are able to kind of focus in on their own business, obviously, and right size their business. So now when things do come back, they're gonna have that much more earnings power. So it was. Unfortunately, it costs jobs and all of that, but from the financial analyst perspective, in terms of the earnings power and the strength of these companies, it's a good thing. So the top line is more important in terms of how strong the economy is bouncing back and how much demand there actually is, but the earnings growth, the margin story is likely stronger than ever because companies were able to trim the fat, right size their operations. Meanwhile, technology companies that are increasingly important generally have better margins than more traditional companies anyway. So like the earnings power of the S&P 500 and our largest companies just continues to kind of strengthen over time.
All right, let me just toss out one risk though, and that is if we do see rising rates, I think that gives the corporate America, the corporations a tougher time to borrow. And I think what has been going on over the last 10 years is we've seen companies borrowing, and then they were able to buy back stock, and then this, Craig. I know you've seen it many, many times that we'll go through our earnings and we'll see, they bought back this much stock. And you see, they bought back just enough stock to make this an impressive earnings result. Now, if buybacks come off the books, then I don't know if that earnings growth story will still be as prevalent. I don't know. It's something to watch. I don't know how to time it. I guess you just have to kind of look at the trend of stock buybacks and whatnot, and announcements and renewals of those buybacks. But it's just something that I'm going to be keeping an eye on over the time.
Well, I think that is, pretty much everybody stopped buying back their stock when there was a lot of uncertainty in the middle of the pandemic, right? Because, everyone maxed out their credit lines because nobody really knew what was going to happen. But now I think that's slowly coming back, and was it a month or so ago that the Fed said that even the banks can start buying back their stock. It's definitely one of the tools that companies have to increase earnings per share, but I'm not sure it's, I guess it's a company or sector by sector kind of dynamic. But I think you want to buy stocks, and this is more of a micro bottoms up kind of perspective than a macro one. But I'm not looking to buy stocks that are or companies that are dependent on buying back their stock to try and manufacture earnings. That's what somebody like IBM or Bed Bath and Beyond did for so many years, and it didn't really work out for them. So that's why I think stock picking is important. But I know that's kind of straying away from the topic. But yeah, I mean, it's one of their tools to increase earnings. I'm not sure how important that really is to the broader story.
All right. So what did you say? 23 times earnings is what the expectation is for the S&P?
Yeah, for 2021, just under there, just under 23 times, which is.
And how does that compare?
Well, I mean, we were trading 15 to 17 times earnings for most of the last 10 years, up until, at some point in the rally last year, late. It kind of got complicated, right? Because earnings estimates were so uncertain and got hit so hard for a while there in the spring during the pandemic. But yeah, I mean, I don't think we really got much past 17.
Though. What's the mean?
I think it was about 15 to 17 times. I want to say it was like 17 times over like the last 5 years, or 15 times over the last 10 years, something like that. And I think if you go further back, it's around there. 15, 16, 17 times, I believe.
Okay.
So it's expensive by any measure.
All right. So that brings me to bring in Scott into this discussion, because from a valuation perspective, it seems like things are a little hot. I wanted to get your technical take, Scott, as to where you see the market. Are we overbought?
No, not at all.
Okay.
From a short-term basis, again, time frame is going to be everything here. So from a short-term basis, we've had a really strong start to the year here. Small caps, mid caps breaking out to the upside, leading the way higher. We're up like 4 or 5 days in a row here. So we're going to get a minor pullback from a trading perspective. Sure, that's totally possible, especially as we go into earnings season. Bigger picture, I mean, my job, it's pretty easy right now because the market is at all-time highs. I went through a whole bunch of charts in preparation for this meeting, and honestly, it's like I can just go anywhere. There's so many industries, so many breakouts, so many new highs, so many bullish charts. This market is just absolutely roaring to the upside. And, I use that word specifically because if you look back to the 1920s with the roaring 20s, one of the key elements that led into the roaring 20s was actually the Spanish flu, which was a big pandemic between 1918 and 1920. And it was also coming out of World War I. A lot of people died, the economy suffered, but once it was gone and cured, everyone was like, let's go, let's live our lives, let's get things going, let's get the economy rolling again, let's put the money back to the system, and let's start spending, and just innovation kicked in and everything else. And I think we're kind of in that same sort of mindset here where the pandemic really, sucked the life out of everything globally. It wasn't just in just one country specific. And I really think that, this mentality of, hey, let's reopen everything and let's get back to work is really going to be a driving force here over the next couple of years. And I've said this before a lot on Trader Audio with Gavin in the afternoons that, if the pandemic only took the S&P down 35%, that's a global shutdown, only took the market down 35%. I hate to see what's going to take us down more than 35%. I mean, that's insane. They literally profits stopped, business shut up, businesses shut down, unemployment went up to skyrocket levels, and the market's recovered. And I think we are on the start of a new secular bull market. I think it was one of the fastest corrections, fastest recessions that we have seen, and the market quickly turned around, and we saw all new rotations developing, specifically in the technology area and the healthcare industries that have really kind of just accelerated to the upside here. And like I said, I can go through so many different areas and strengths, and the money just keeps rotating from one hot group to the next group here, and that's the signs of a bull market. market. Strong rotations through different sectors and industries in the market. I guess the only thing I can really say is what are we watching out for? Like, what are we looking for signs of a top? And I mean, it would just have to be something price action bearish. Simple stuff. Heavy distribution days, multiple distribution days to the downside, breaking below 50-day moving averages, breaking below weekly trend lines, weekly support levels. Look for the defensive groups, utilities, REITs, which are still trading below their 50-day moving averages. They're not going anywhere. There's no money going into the defensive space. Staples, XLP, just kind of going sideways here to start the year. The last couple of weeks, not doing a whole lot as well. Gold's a little tricky, I think, because it seems like crypto's like gold 2.0, so you're kind of seeing more of a move there with the dollar value declining and whatnot. But gold is actually coming in really aggressive today after a little bit of a strong start to the year. But it's just not a defensive market at all. And you're seeing small caps and mid caps breaking out, leading the way to the upside, which is the more speculative asset classes. I think we have a very, very bullish market in front of us. On a side point too, the years that end in 1 on a historical basis often start off the first half of the year pretty strong. For what it's worth. If you go back in history and look at every year that ended with a 1, they've basically ran all the way up until the sell in May rally. Of course, you have your little dips and pullbacks here and there, but they usually have pretty strong first halves of the year, and then it gets pretty choppy throughout the second halves of the year. So we have a new administration coming in. I think, after January 20th inauguration day, you got to have some changing of the guard. There's some probably, regulation discussions and everything else about the taxes and everything else you guys mentioned, interest rates, et cetera. That it might slow down the market a little bit. You have earnings season coming into the batch there. So there's going to be, some chop, I think. But overall, I think my overall outlook for the next couple of months is very bullish. And it really just comes down to just kind of identifying the leading spaces in the market and just jumping on board those trends.
All right, so Scott, you appear very bullish. I'm going to bring Brett back into the discussion. Does the sentiment data jive with what Scott's talking?
So no, but that's not necessarily a limiting factor because again, if this is a retail-driven market, the sentiment data signals that we're seeing can just simply get more and more extreme. Now, there's some limit on that, and so basically everything that I follow is near or at extremes in terms of already, and that's, we're talking about the surveys are matching up with the options data, is matching up with the cash levels, is matching up with everything. So across the board, any input you take on sentiment positioning data says that people are already really, 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 really excited about this market. And the question is, are we bringing in new market participants? Because when you get to that point, that's really where you have to be to fuel the type of next 2-3 months and maybe next year or two that Scott's kind of feeling in some of these chart breakouts, and it certainly can happen. I mean, it's like, is this 1996 or 1999? And I don't know the answer to that question, but I can tell you a lot of the measures that I follow are already sitting at
97.
What's that?
97.
97. Okay, 97 is fine. I mean, this could very well be.
I'll go right between you.
Yeah, no, I mean, and it certainly could be the case, especially if, we've got one of the things Morgan Stanley's been talking about is the amount of inheritance money flowing down to millennials and Gen Zers, which is supposed to be like 60 or 70 trillion flowing out over the next decade starting a couple years ago. So you've got this wealth that's maybe been locked up in very conservative investments shifting in the hands of people with more disposable income and a different time horizon and a willingness to be more speculative and a willingness to be more aggressive with investments. And that's similar to what we saw in the 1990s. So you can have that kind of process take place here. Of course, there is still 2001 looming somewhere in that picture. And a lot of the people, as I said earlier, who are maybe a part of that picture aren't old enough now to have really experienced that process, and that can help let it happen because those same lessons weren't maybe learned in a very personal way. But if there's one caveat here to the idea that, so we're seeing a lot of extremes, right? We're seeing, and I said this reminds me of January 2018 a little bit too, which would be something that would contradict Scott's technical projection. But it is technically not the same. It's just very, very similar in sentiment, and also in getting past the recent bullish catalyst with the fiscal stimulus bill passing, and at that time it was December 2017 passage of the tax reform bill, and then we had a parabolic move the following January, and then we crashed 10% in a couple days. It's possible we could see that, or it's possible that we do have this kind of rotation that's always going to come in and heat things up another notch. If I had to question myself about the sentiment data reading, the one way that I would do it is something I started talking about over the summer, is the nature and function of the options market appears to be changing on a very fundamental level. And I'm starting to believe that more and more. And what that really means is, for the first time, really, I think ever, you've got a lot of new market participants coming in who just don't even bother with shares, and they're just trading puts and calls. And that really, when you start to look at, because it's happening on such a widespread level, when you start to look at things like put-call ratios, it's really, really suddenly very difficult to do apples-to-apples historical contextualizing. It just doesn't match up. It doesn't mean anything that put-call ratios are getting so low. That's possibly a way that I could play devil's advocate with myself. But again, this is something that's going across surveys, options data, positioning data, cash data. It's all lining up to show these extremes. So taking the options data out would basically suggest that we are still at bullish extremes right now, even though maybe we wouldn't, if I take that factor out, we wouldn't be 2 weeks ago. So we're just getting to extremes now. But, the price action is going to be telling. If we get really good news, the market can't rally, I think that you've got a two-way market with a lot of movement.
All right. Well, let's shift gears a little bit, gentlemen, and let's talk about some trading ideas. Damon, you've been awfully quiet, and I know you got a lot to say about the SPAC market. One of the things I want to ask you, Damon, even just this morning, I was going through the news and I saw, I don't know, maybe 8, 9 SPAC IPOs. How do you sift through the good ones and the bad?
Give me just a second here. I am posting a trade in a SPAC right now.
I can answer that. They're all good. Buy them. Just keep buying them until they stop going up.
Okay. So just so you know, I just posted a trade in a SPAC, and no need to hurry to buy this one. This is a deal that came out in September. The company is Starboard Investments. We've made money in them in the past with Papa John's Pizza, activist investment firm. I've been very impressed with how they operate over the years. I think they'll probably buy maybe something like a restaurant, either a growth kind of situation or a turnaround situation. Really highly regarded investment firm. And SPAC is trading right now at 1060. They're not going to do a deal unless there's price upside, right? Like some of the SPAC sponsors do a deal just for the fee, so they get a piece of the company. That's not what Starboard's going to do. They're going to try to make money. They're going to try to make a lot of money. So the downside is that they have until September 2022 to find a deal. So money could be tied up for a while. So I'm kind of using these SPACs, ones that I like. It's almost, you're not getting any money on your savings accounts or your money market accounts. So if I can get a SPAC that's close to the trust value, which, we've talked about before with SPACs, that if they do a deal that you don't like, you can get your money back, right? And so typically that's around $10. Sometimes it's a little bit less. You have to look at the actual filings, but typically it's going to be around $10. So we're buying it here at 1060. Downside is essentially like 6%. Upside could be 100%. So I like the risk reward of that. You're seeing some of these SPAC deals do spectacularly well. Sometimes 50%, 100%, 200%. 1,000%. So just trying to sift through these names and find compelling opportunity. And so, Jim, going back to your original question, so I go through every one of these deals, and one of the key things that I'm looking for is a strong sponsor. So, for example, Starboard, right? If Starboard gives you a call, you're going to pick up the phone. And what is the incentive to there? There are dozens and dozens. There might be 100 SPACs out there, right? So if one SPAC calls you, never heard of these guys, versus a SPAC like Starboard or the SPAC that's run by a founder of LinkedIn or the founder of Square or a major private equity firm that's done lots of deals, whose call are you going to take? And so that's one of kind of the more consistent things that I'm seeing with the SPACs is that the companies that offer the most upside are the ones that are typically doing deals with real players. And because those people are bringing value to the table in terms of operational excellence, relationships, they're able to buy the company at a cheaper price, right? Versus a no-name SPAC sponsor. They're going to have to pay through the nose just to get the deal done, or it's probably a crappy deal. So that's kind of my general approach on this.
All right, and outside of SVAC, which you just put on, any other names that you're liking?
So we have a long list of SPACs in our portfolio right now. So earlier today, we took profits on some of the STPK warrants for 110%, 112%. We put those on about 3 weeks ago. Took some profits on FII, FIII for 28%. Put that on about 2 weeks ago. So in case you missed my SPAC portfolio commentary, if you plug in the focus ticker, FOCUS, you will see the names that I've been buying. So those include BOWX, and we bought the units at 1085. So the units are a combination of common stock and a portion of a warrant. And so typically with these SPACs, a unit is the first thing that comes to market. So when a SPAC IPOs, they're IPOing units. And so the unit is one share of common shares plus a partial share of a warrant. And that partial share of a warrant can change. So when SPACs first started to roll out, you're typically seeing that unit contain half a share of a warrant. As SPACs have become more popular, the sponsors have had to essentially give away less warrants. And so now you're seeing deals come out with 0.2 warrants associated with a share of the unit. So a fifth of a warrant contained within the unit. And I think SVAC has a fifth of a share of a unit of a warrant within the unit. So that's one of the reasons we're buying the common shares instead of the units. The warrants are also an option. They're trading about 220 or so. So if you want to tie up less capital, the warrants are an option. Now the thing about the warrants, they're typically exercisable at 1150. So stock goes to 20, that warrant is, theoretically going to be worth 850. Typically you don't get that. It's typically some type of discount. So that warrant might be closer to 650 or 7 or something like that. But so if you bought the warrant at 2 and the stock went to 20 something, then you're probably going to triple to quadruple your money on the warrant. So they offer a lot more leverage. The thing about the warrants is if some reason the company, after 2 years of looking for an acquisition target, they can't find one, then you get the liquidation value on your common share. So like you get that maybe $10 per share in the trust, but the warrants are worthless. So that's the downside of buying a warrant. And that's why I only try to buy warrants in either companies that have already announced a deal or really strong sponsors that I feel really comfortable will eventually find a deal.
Hey, Scalp, so we got a question that rolled in that asked, what SPAC do you like? And I know you like a lot of them. Would you say a fairly good strategy would be to take a look at your focus list, look at the ones that you've done, and maybe buy the dips or buy on weakness on those names? And that would be a good representation of what you actually like.
Well, let's do a little work here. A lot of these SPACs that I've recommended over the past couple of weeks haven't moved at all. So, right, just pull up the tickers, and one of the things is that we're trying to spread money into a variety of names, right? So there are hundreds of SPACs out there. I'm out there trying to identify names, strong sponsors that will announce a deal that will give the stock some pop. But that said, look at our STPK position, right? This thing's taking off right now, up 24%. The warrants, I mean, it's breaking out to all-time highs. And this is one I've been talking up since about 13 or 14. We own the common, we own the warrants. The warrants are probably up. Let's see what the warrants are doing right now. I mean, stock is going nuts right now.
Is there a catalyst on this one? I'm looking around. I don't see one yet.
So this is kind of a pure play solar storage software play. So there's no other solar storage software play that's out there. And so typically in solar, you're dealing with hardware, lower margins. People like software. They like higher margin software businesses. A hardware business, maybe you can get 5 to 10 times EV to sales multiple. Software, you can get 100. I mean, if you look at some of the deals that are coming out, Trend knows better than me, but I think Snowflake and AI, where are those trading, Trend, in terms of valuations, EV to sales?
Yeah, Snowflake is was like 90 times earnings. AI is
times sales or earnings?
Forward sales multiple.
Okay, yeah.
I got like 87 times for Snow and 64 times for AI.
Okay.
And there's a bunch of other ones that are above, 30 at this point.
Yeah.
There's a lot of them.
So I think the STPK, I mean, it's probably, I don't know, when they did the deal, I think it was maybe 1.8 times revenue, EV to sales. Now it's probably 4 times, so.
Not a lot of debt there either, right, Damon?
There will be zero debt. They'll have, I think, $500 million on the balance sheet of cash. Yeah. So look, I mean, I literally just posted an idea, SBAC, so there's one I like. I can go back through BOWX. It hasn't moved. BOWX.U hasn't moved since we entered it a few weeks ago. CCAC, I still really like. And we're up. We've made a double in the warrants already. I also added the common shares a couple of weeks ago at 1027. Hasn't really moved. This is a highly regarded Asian private equity firm. I want to have some exposure to Asian SPACs, and this is the type of firm that is going to have the relationships to get an attractive deal done. One that I'm looking at that literally just priced today that I find pretty interesting, but I'm not ready to buy it yet because I think it's maybe a little expensive. But SV, Sam, Victor, Frank, Apple, and the units, so Unicorn, and this is the SoftBank SPAC. So this price today, we all know who SoftBank is. They're a major player. Venture capital. I think they literally have like $100 billion fund. They're involved in like every major deal out there. So they will be able to bring something to market. There will be people who want to link up with that brand, and I think at some point the stock will potentially do very well. However, I'm waiting for, I'd like to see if I can get some type of pullback into the low 11s to buy it, just because, again, it's pre-merger announcement. we have a lot of volatility in the market. Say we get a sharp pullback a month from now in the general market, some of these SPACs will pull back as well. And so you'll be able to buy this one probably in the low 11s or maybe in the high 10s.
All right.
Damon, I got a quick question for you on this space. What do you think is a derivative play playing like private equity off this? I know there's PSP out there. It's got a pretty high expense ratio, but I would think that this is a space that's winning on a lot of these SPACs being rolled out. Have you ever looked at that as like a derivative play off some of these SPACs?
A derivative play. I mean, I think there is the SPAC ETF that we talked about recently. And that's one play. There is a one that rolled out, a new SPAC ETF that rolled out a couple of weeks ago that I liked it more than the original SPAC ETF, which I think was SPAK. I think we talked about that one a while ago. And that's actually done pretty well. I mean, since November, it's risen from 22 to 29, but I think it started maybe when it priced, I think it was maybe trading 25, 26. So it's up a little bit. I have to search around for the name of the other SPAC ETF, and the reason that I like this one in particular is they kind of take a similar investment style to me in the sense that they're buying offerings. They're even taking it a step farther. They're participating in the IPO, which means they get the warrants for free. And so typically the warrants, when they start trading, they're trading anywhere from $1 to $2.50. If you participate in the IPO, then you get the actual warrants for free. It's like part of the package, right? Part of the basically the promote to participate in the IPO of the SPAC. So once I find that, I'll post a comment.
I think it's SPCX.
Okay, yeah, that is. Yeah. That's it, SPCX. And there was something that prevented me from buying it aggressively when I first saw it a few weeks ago. And I have to think back through what that was. Maybe I just thought I could do it better than them. But yeah, I'll take another look at that one and do a follow-up comment.
All right, Damon. So you will be very active in the SPAC space, and you can get some pretty decent-sized returns there. Someone no stranger to big returns is Trend Tracker. I know that you don't have a ton of turnover in your ideas, but I reckon that you have something brewing in the lab back there. So what do you have for us?
I don't have anything necessarily new. I've had a few this week. I bought Abcelera, which is a recent IPO. I bought Autodesk 2 days ago, and 3D Systems, which is an interesting one. I maybe exited a little too early today, but I wouldn't be surprised if this thing kind of shakes out a little bit. I'd like to get it back under 20 because now, this is, I don't know if anybody remembers the 3D printing bubble of 2013, but Triple D put in a pretty ridiculous move back in 2013, and it's kind of been left for dead ever since. Similar to like a move that like FireEye made. I think it's a decent comparison, where it's just kind of been left for dead. Now all of a sudden they come out with this nice pre-announcement. I hadn't looked at the stock in a long time, but it seems like they're doing the right things. They divested some non-core businesses, and they're just focused on the industrial and healthcare verticals. In a world where we have all these software companies trading at insane multiples, and we have all these SPACs that are trading at insane multiples, DM, Desktop Metal, is one of these next generation additive manufacturing companies that was a recent SPAC. I'm trying to remember what the SPAC symbol was initially, but it changed over to DM, Dog, Mary, a few weeks ago. and it's a very promising company, but it's similar to these LiDAR SPACs that we have seen where their sales are pretty minimal right now, and they're kind of just projecting this hockey stick growth starting either this year, next year, so they're projecting triple-digit growth, but there's really little revenue to speak of as of right now. So, DM is trading at like 80 times revenue or something. If you go further out, obviously it'll grow into that a little bit. But if investors are willing to pay up for a next generation additive manufacturing company like that, then all of a sudden, as long as Triple D can be putting in some growth with some margins, if they've righted the ship and they're actually posting strong results, then all of a sudden this thing looks sort of cheap and could play catch up to some extent. So I'm out of it right now. I'm hoping it comes back into mid to high teens. Maybe we can reload. But it was a nice trade, at least yesterday into today. I bought more of that good RX this morning, so it's one of my larger positions now. The valuation isn't super attractive yet. It's still a pretty rich valuation, but again, this is solving one of the biggest problems with our economy. Amazon isn't going to. It can certainly limit their growth longer term, but there's smaller competitors already going after the same market. The prescription drug market, I think, is big enough where this company will be able to thrive, at least over the intermediate term. And so this is one that's sort of out of favor now. And then what was the other one I was going to mention? Yeah. Well, Lyft was my other big pick for 2021. Now, I'm not sure if it's going to take until more normalization happens in like the summer or back half of 2021 when things really open up and this stock can take off. But comparisons will get very easy starting in mid-March. So, that Q1 report will start to look better, and then for the rest of the year, the comps are very easy. And then if things actually do get back to normal and people are going to work and traveling, then this thing could really turn into a momentum stock and has plenty of upside because the valuation isn't egregious. I want to say it's 5 times forward sales, and those are sales that are still kind of depressed. So theoretically, a year from now, if we are in, let's hope, early 22, we can kind of put a lot of the pandemic stuff in the rearview mirror, then this business is going to be doing really well, and it's still not very expensive for a leader in a huge transportation market. I can keep kind of going over different positions that I have, but I guess that's it for now. Two different EV stocks that I liked. One was an IPO and one was a SPAC that have done well are LI and NGA. I haven't added to them recently, but they've both done really well. So, I'm just constantly looking for, value in all these growth stocks. I might have to start looking for more value, growth and value stocks, or start looking more at the value cohort if that's what is really going to be rocking this year, because I really don't like paying 20, 30, 40 times sales for these companies. I really liked, what was it, C3.ai. I exited it too early. I think this is setting up for more of a short than anything because they're not really putting up great results yet. And it's trading at 60 times, 70 times sales. So they're going to have to show that they're kind of worth that. As of right now, it doesn't seem like they are in terms of the numbers they're putting up in the current environment, current quarters, but they're going to have to at some point accelerate their growth to a respectable level to justify the valuation. Airbnb is one that I think is probably a buy on weakness. But Dash and Airbnb will be certainly interesting stocks to kind of monitor. Both leaders, one kind of benefited from the pandemic, the other one got hurt, but actually bounced back a lot faster than the hotels. So, I mean, there's just between SPACs and all the strong IPOs and all these software stocks, there's plenty of opportunities out there. So I'm just going to keep looking for stuff to buy on weakness. And there's really not too many dull moments with all these SPACs constantly coming out too. So it's almost every day we see a new issue via SPAC. So I mean, me and Scalp Trader are just going to keep looking for those opportunities, and should be an exciting year.
All right, Craig. Scott, Blue Chip Trader, I don't want to leave you out, but I know that you do articulate your ideas on a daily basis, but do you have anything that's really hot on your mind that you'd like to bring out?
No, just pretty much, everything looks so bullish right now. And I understand concerns that things, are probably overbought, overheated, but I can't be bearish on this sort of market. One area that I would just kind of highlight that I don't see a lot of people talking about would be the foreign markets. EWJ, Japan is at all-time highs. India, INDA, Australia's creeping up on the right side of the chart there. Emerging markets, EEM is doing well. Ireland is doing really well. Switzerland's doing well. I mean, you have all these ETFs that are just really just making their way higher. If you're looking for just a vague one, I mean, the VGK is a nice one. That's the FTSE Europe one. Also
you know what
There,
underperformed?
so.
Speaking of the FTSE Blue Chip, what underperformed last year was the FTSE itself. So the UK. Now that Brexit's out of the way, maybe there's some value there.
Yeah, totally, and it's just I think if we have the U.S. markets, just breaking out to new all-time highs, a lot of these European and foreign markets are just kind of starting to perk up to their fresh multi-year highs. And if you look at a long-term, like decade-long charts of these things, so they could be on the verge of breaking out there. So I keep them on the radar. Crude oil is go ahead.
I would just, since you're talking about the emerging market economies and stuff, there was a few that I had listed. Number one, I took that LYG long a couple of weeks ago, right before the holidays, as a play on Brexit. I think that's kind of been tracking the UK a lot here. I'm expecting it, if you look at it on a weekly, for it to bubble up over that too once we get some of these Brexit deals in behind us, and it has a very realistic chance of making a run to that 3 level. That's a 50% return there. And then for those emerging market ETFs, a lot of them have run, but this IAI is a pretty good one. This is iShares Asia 50. Another one that I was looking at is this AAXJ. I like the ones that are ETFs that are ex-Japan, just because the other ones are going to benefit a little bit more from the weaker dollar than Japan will, because for Japan you're going to see the stronger yen, and that's going to impact their exports, and it's, they try to drive their economy via exports. So I like some of these emerging names ex-Japan. Another one, EEMA, is another one that's emerging Asian Pacific ex-Japan. Mm-hmm. So all these really fall into that category that you were talking about, Scott, in terms of having some nice runs. But I'll post a few of these to the site.
Yeah, I mean, a lot of these groups here, they are looking really short-term, overbought on a short-term basis. But just these, because of the trends that are in play here, because of the constructive breakouts from multi-year bases, breaking out to fresh all-time highs, these are groups that are basically going to be totally worth looking at on pullbacks to just obvious levels like 20-day moving averages, 50-day moving averages, and whatnot. So I just see so many bullish areas breaking out here. And I know we're running a little tight on time here, but just keep tuning into Trader Audio every afternoon, and we go through all these sectors and ETFs and everything else. So there's just so many ideas here.
Yeah, indeed. And I don't want to leave Chart Trader out. I noticed earlier that you were thinking about getting back involved into gold via GLD. Have you been able to weigh in on that?
I have no, so I'm actually considering ditching the position,
Oh,
but
ditching it. Oh,
well, no, both. So your statement was correct. One of the things that I'm shifting toward is possibly a dollar bull bias, and that makes it tough to stay with it. But on a shorter time frame, I feel like we're in a trading range in gold, and I think that there's going to be uh, more to the upside there, and it's just tough to reconcile the two ideas. The dollar bull idea was basically based on what we said at the beginning, in terms of the shift toward having a more cohesive federal balance sheet intrusion into dealing with a crisis situation. And I think that there's a ton of dollar bear bias out there in terms of analysts, in terms of positioning. Gavin and I have been talking about this position since the summer. We took a very dollar bearish position at that point, but I think that some of the shifts that we're seeing lately can shift that around. There's two difficult things for me to reconcile there, because I'm still bullish on crude oil and I'm still bullish on gold, but gold will be particularly difficult during that period. The other thing I want to mention is, as we've discussed over the years in doing this, I segmented my capital in mid-2016 into a future trading account and an externally managed fund-to-funds low turnover strategy that was tethered long to risk assets. And I just wanted to let people know who've been following that idea. I've started the process of returning half of the fund-to-funds capital back into my trading account to increase the leverage that I'll have if we start to see this market top, because I think that a top at this point would start to introduce what would be very, very much my bread and butter type of situation, but also to begin probably trading more bottom up. I used to trade individual equities a lot, and to the extent that we continue with a retail driven bull market that's headed into a mania stage, there'll probably be a lot more opportunities on bottom up trading than top down trading. So I just want to let people know that that shift may be coming.
all right. Well, good stuff. Good stuff from everybody. I think we could probably do this all day if we really wanted to, but at some point, I think we gotta put an exclamation point on it all. Gentlemen, I'm going to bid you all adieu. Thank you for your time today and all the ideas. Again, stay tuned to Trader Audio as these guys will articulate their ideas. It's on the page, and Blue Chip, I'm sure you'll have some follow-up later, as will Event Trader. So I want to thank you all on behalf of the listeners and myself. Good day, gentlemen.
Good day to everybody.
Have a good one.
Thanks, Jim.